knowing that commercial real estate is stable, people purchase these properties and hold them for a long period of time. Sometimes 5, sometimes 7, sometimes 15, sometimes 20 years, and sometimes they're passed through generations to generations. But when these people own these properties and then they have little to no debt meaning no debt encumbered on the property, and they own it free and clear, they're concentrating on one thing. Same thing we're all concentrating on. Why sell it if it's cash flowing, right? Well, then certain things can happen and they want to go ahead and max out their equity, and they maybe contact a financier, and the financier says, sure, we'll go ahead and do a refi cash out, but we're going to go ahead and charge these points. And they say, well, I don't want to pay any money, right? I don't want to pay any money to anybody for points. I just want to get all my money. So what I'm going to do is I'm going to go ahead and sell it. Well, what they're selling it at is the value that it's operating at. But what they don't know is they've owned the darn thing for so long, nobody raises the rents. So what we're buying it at is the current income. When the rents are so low, we can just get in there, and 9 out of 10 times, these people that own that property for that long and own it free and clear and are motivated to sell, we can go ahead and sometimes, get this, guys, pay what they're asking and possibly just a little bit more to get favorable terms. And what we can do is get in there and raise those rents. Do you know what you can charge a nuisance rent in self-storage, like $10 on self-storage? And the NOI goes up. And when the net operating income goes up, the value goes through the roof. You can improve the value of a property $250,000 by charging a $10 rent increase. Can't do that in residential, guys. Just can't. So when I say this, I'm talking about properties that maybe are that, color like from the 70s. What color is that anyway? It's like that pinkish or that greenish, that avocado-ish color, those buildings. You guys have seen them. And a little bit of the plaster's falling off, and they just need rehab, guys. That's nothing. Coat of paint, redo the front of it. I mean, this is nothing. And get in there and raise the rents. Or maybe it's a self-storage facility. Maybe it's out of date. Still the roll-top doors. It's just sitting there ugly because it's dated. Put a coat of paint on the thing. Maybe put a security system there. Maybe change the name. Change the name. A1 Security Self-Storage or what have you. Putting a name in there that says security self-storage, right? Getting creative like that and charging, and when you raise those rents, the value is going to go through the roof. And then what you do is you go ahead and refi, and a lot of times you can just go ahead and buy that thing for pennies on the dollar. Absentee owners are very, very powerful. Now, building management companies as well. Sometimes they're neglecting properties. Out-of-town owners often are unaware until it's too late. Because if they're managing the property and they're just running the thing into the ground because they don't care, and they figure, well, the owner doesn't live here, so they don't care, and the thing just sits there and it's mismanaged for a long period of time, then what you can do is get in there, and when this happens, the asset turns to liability, and then the owner becomes a great prospect for you guys. All right? Now, with land, we want to be able to buy it by the court and sell it by the shot. Okay? Now, when it comes to land, I'm going to go ahead and cover some things to identify real quick here. When it comes to land, we want to be able to buy it well below market value and improve the use and sell it off quickly. That's what we want to do. We want to get in there and get it approved. We should be looking for land that's perceived to be on the market for low cost per acre or low cost per square foot. Right here, agricultural land is sold by the acre and commercial property is sold by the square foot. You guys take these notes, please. Agricultural land, AG is the term. And agricultural land means that it's land that's sitting as agricultural zoning. But get this, a lot of these sellers just do not want to go ahead and change the use just yet. They own it free and clear because once you change the use to commercial or residential or mixed use, then you're also responsible for the tax that you have to pay on that. It's a higher tax bracket. So they want to keep it as agricultural, right? They want to keep it. And then a lot of times what they do, if they're a big landholder, let's say 500 acres, what they'll do is they'll go ahead and get 100 acres approved, and then they'll sell it. They'll get another 100 approved, and they'll sell it. Another 100 approved, they'll sell it. That's their mission. But a lot of times the property's passed through generations. Somebody else inherits it. Somebody doesn't have the same exit strategy. No. They want to have sex, drugs, and rock and roll, right? It's a joke. You guys can laugh. It's okay. What I'm getting to, guys, is people's motivation are different every time they sell, and sometimes property will be sold by the acre versus what it should be sold at its future value. People are so fixated on what is, not what could be. All right? Now write this down, guys. Sometimes the property for sale are the ones, the best properties are for sale are the ones that are not for sale. Sometimes the best properties for sale are the ones that are not for sale. And that comes to direct mail and some creative ways to get in touch with these landowners. But I want you to realize something here. We don't need a calculator for this one. Agricultural land is sold by the acre. That's how it's done. And that's how we find these properties, is by the acre when you're looking for agricultural. So if you're looking on loopnet.com or various other websites, which we're going to show you through the Finding Deals session later, when we're looking for agricultural land, it's sold by the acre. Commercial is sold by the square foot. Now, there's 43,560 square feet. That's 43,560 square feet in 1 acre of land. It's a lot of square feet, right? 43,560. Now, think of it like this. If you were to go ahead and purchase property by the acre, let's say you purchase 100 acres at $10,000 an acre. All right? 100 acres at $10,000 an acre. Then what you do is go ahead and change the zoning over to commercial, and you sell it for $10 a square foot. Do we need a calculator for that? We're talking about millions of dollars, guys. Millions of dollars in value on this land. And while you're getting the actual property changed over to its highest and best use, you can also have some profit centers on it as well, all right, which we're going to cover later. But just understand the power of getting the plans approved, because that's one way that we do it. Let's go ahead and turn to 18. That's one way that we do it. So we're buying land already zoned for something other than agricultural. You want to buy it for a low dollar per square foot and convert it to a high dollar per square foot by changing the use or creating a development plan to create value. Now, getting a development plan in place, guys, we're not talking about getting dirt underneath our fingernails. What we're talking about is just getting the plans approved. Getting in there and getting the plans approved. That's step number one. Changing the zoning is the first way that you can make money with land. Now, the premise of this is cash flow, but I want you to understand that we can do some things with land to get it cash flowing. But the first way to make money with land is to change the zoning. That's a big, huge, huge bump. The next one is to get the plans approved, the development plans. That is absolutely huge as well. You can carve parcels on paper. Once you have a tract split, you can go ahead and carve it into smaller parcels and sell it off. Just like I mentioned, somebody who owns 500, they can cut off 100 and sell it. It's all done on paper. We're not talking about out there with big bulldozers cutting land, okay? That's what the engineers go out there. They look at the property, the grading and grubbing. We bring in the development personnel. They do all the horizontal infrastructure is what that's called, okay? Horizontal infrastructure, all right? When you're buying commercial land, what you want to do, or any land that has already been approved for plans, it's platted and fully titled for develop, it's more important to focus on what it's worth now versus what it could be worth later. Why? Why is that? Because a lot of the profit has already been realized. What I'm saying, guys, is don't be sending me land that's already zoned to commercial for partnership deals unless it meets my joint venture criteria. Because we're not retail buyers. I don't want land that's already had its upside realized, right? They're doing what we're doing. You guys get that? Say yeah. Okay, good. You got to understand that. If they're already taking it from, let's say they go and you get in touch with an investor and he says, look, this is a great opportunity here because you could make a boatload of money by getting some plans developed or doing some development, going vertical and actually putting buildings on this land. You make a lot of money. Well, so many people are fixated on that. They're like, yeah, I can do that. I can make a lot of money. But what we're buying, we always buy as is, right? So since we're buying as is, if this person, let's say, behind the scenes, and they didn't tell you this, they bought it agricultural, 100 acres, right? They bought it at $10,000 an acre. They went and got the zoning done. Now they're sitting on a boatload of money if they could sell it at, say, $10 or $15 a square foot. But what they're looking to do is sell it to you, let's say, for $9 a square foot. See it all the time. And then they're trying to sell you on the fact, hey, all you need to do is come in and just get the plans approved and you can make money. Or come in and do the development and make money. But we want to be in their position. We want to get the first big value bump because that's the major value bump right there. That's the value. That's where we realize that value. Okay, I'm going to share some value slides with you guys a bit later so you can see that in transition right in front of you. And it's going to apply to land and also income. So you can see the value of what we're doing here. You got to see the value. But don't get hung up on that. We don't buy land at retail price unless, this is it, here's the rule. All right, we will buy it at retail. And these deals, guys, are all over LoopNet. They're all over tons of different websites out there. You're going to see them all over the place. Brokers are going to bring you retail deals. Do you get that? They will. That's their job. Their job is to sell stuff. But your job is to say to them, look, it's fine that it's retail if it meets this criteria. And if it doesn't meet this criteria, that's fine. But just go back and find something that's not at retail for me where I can buy it with some type of a discount. And this is it. Here's the indicator right now. The seller's willing to do the JV and bring the land as a contribution to the deal. They're willing to go ahead and bring it in. Now, there's some key identifiers for that. Number one is very low debt. Now, normally, I would say free and clear. Until I had a deal come through the pipeline that I plan to share with you later where there was $5 million debt on this property. But due to the upside, and due to the as-is value of where it is right now in its current state and its current condition, that $5 million was change that you would throw on the counter before you take your pants off to go to bed. All right? So it all depends on the deal. It all depends on the deal. That's why I said low debt, write that down, low debt to free and clear. All right? That's my rule. Now, number two, of course, is free and clear. Number one's low debt. Number two is free and clear. Now, joint ventures will be discussed later in detail in this course. I'm going to pick apart a JV deal so everybody understands. And the reason why I want you guys to understand a JV is because they're so very common to come through the pipeline. And I know each and every one of you, and each and every one of you listening to these CDs or watching these DVDs, you're going to run into retail deals because they're out there. They're plentiful. It's not hard to find a retail deal. I could pull up this computer right now and go on any website and find a retail deal. Okay? And what you're going to uncover when you're speaking with this broker is that a lot of these deals are owned free and clear in the path of progress, and they're with motivated sellers, so we can get in there. All right? Now, commercial real estate, from my experience, land deals have been turning much bigger profits, and there's way less competition. The reason being is because developers out there, what they're looking at are deals that are not low-hanging fruit. They're looking at projects way out of the path of progress so they can do something called land holding. And write that down. Land holding or land banking is nothing more than putting your capital into a project, purchasing land, and then waiting for the path of progress to catch up to you. It's guys, it's the same thing as when people buy income property and they barely even breaking even and they're waiting for appreciation. It's the same thing. These developers and builders, right? They're out there and they're buying land for appreciation. Okay? They buy for appreciation. If you find a developer or builder that's got a project they've in the path of progress or something that's red smoke and hot, I can assure you that they're either going to be a savvy investor or they're going to have to own it for a long time. And when people own something for a long time, they like to pay down the debt till it's free and clear. Free and clear property, land, is out there and it's plentiful. Okay? It's out there. Those opportunities are all over the place. All right? You can simply create value by turning the property to its highest and best use. Now, the way we paint the picture when we get into negotiations in JV, I'm going to share with you how I do that. We paint the picture. We say, look, this is what we're going to do. We're going to go ahead and bring in the project management team, the development team. We're going to make it all happen. Boatloads of money. But we also have it where we can do a buyout at any time through that process. So, yeah, we want to go ahead and take advantage of all the different value bumps, but we can also capitalize and cash out and get it done anytime we want. We just turn it in. That's quick-turn commercial real estate. All right? So when working with land deals, they're much easier to manage than smaller investment properties and buildings. They are. Why do you think so? Maybe there's no tenants on land, right? Right, guys? Okay. Now, after the deal gets into contract, you only have to deal with a handful of people before the check arrives when it comes to land. The professionals we use on land are as follows. So write these down. Number one is the brokers. Okay? And the reason being is because they help facilitate the deal, to put the deal together. And there's a way that we work with brokers. And when we talk about working with brokers later, I'm going to share with you how we keep them interested in the project and keep them on our side, regardless of who they're representing. They have vested interest in us from day one because we're the player. We're the one making it happen. Number 2 are attorneys. We use them always, guys. Write that down. We always use them to draft contracts and agreements. This is my disclaimer to you. You should not be doing this business writing your own contracts and agreements. Always have an attorney review your contracts and agreements. Always. Okay? It's very important to do so. And if you do deals with me, that's the heavy lifting. What I will go ahead and provide for you are the professionals. Next are appraisers. There's something on appraisers I want you to write next to it, and that's MAI. M as in members, A as in appraisal, I as in institute. Okay? Members of Appraisal Institute is what it stands for. And the reason why MAI appraisers are looked after and regarded so highly is because they have to go through a special training to get like one of those badges. They basically got a badge that says, I'm top of the game. And they're not going to go ahead and risk all that training to have that high status to go ahead and fluff numbers for somebody, as another appraiser just might. Remember, guys, commercial real estate is buyer beware. Caveat emptor, buyer beware. So because of that, an MAI is where we want to be at when we're getting an appraisal. We know that if it's an MAI, it's good. Now I'm going to get into appraisals in detail for you, and we're going to discuss how we can cut cost on appraisals, we can keep our costs down, why appraisals are so very important, when we get appraisals, why we need appraisals, and why we don't order them right out of the gate. Okay? We're going to talk about all that because it's so very important, because that's how we're going to know the value, the as-is value, and also, write this down, the forward-looking, future value. Okay? That's very, very powerful there. By the way, guys, the MAIs are the ones that the lenders want to see, always. Okay? Now, engineers, they draw the conceptual plans. They give you a scope of work. Write that down, scope of work. Have to get a scope of work from the engineers. I've dealt with so many engineers out there. And I tell them straight out, look, what I need is this. I need an action plan. They say, a what? An action plan. I need to know what you're going to do, when you're going to do it, how much it's going to cost, when it's going to be done, if you expect any delays, if it's going to take more time. I need a scope of work. I need to know exactly what you're going to do and when you're going to do it. No different when you're rehabbing a property. You don't tell your contractor to come in and work by the hour. Your engineer's no different. Imagine how long a rehab would take on a house if you told somebody to come in and work by the hour. Ask me how I know that. Okay. You want to meet with the city officials and walk through the process. And that's not you, because you're not the professional. The engineers are the ones that get down there and walk through this. You want to ask the engineer, you've been working in this area for long, sir? And the engineer will either say yes or no. How many projects have you got done here over the last year? When's the last time that you actually got plans approved? Do you know people down at the city? Are you a regular down there? How often do you go down there? When's the last time you walked through the door? I haven't been down there in years. Bye. You know, we want to talk to the people and do business with the people that are active, people that are performance-based, the guys that are down there doing it. Project managers are also somebody, write that down. They oversee your project and make sure everything goes smooth, okay? They do. Now, my project managers back here, my acquisition team, what we do is we go through the properties in detail to make sure they're there, but we're not doing that particular property management. We bring in a property management company, same as you should, that manages the property. What we do is we micro manage them from afar, and we just stay on top of everything and overlook all the paperwork, making sure that it's there, okay? Now, I typically use attorneys to review contracts and insert additional specialty clauses that protect us as buyers. Is that important? Guys, hello? Okay. It all comes down to doing deals with so much profit and so little risk that a deal can absorb mistakes, miscalculations, delays, cost overruns, etc., and you can still make a lot of money. We always focus on trying to minimize risk and maximize profits. Write that down. Minimize risk, guys, and maximize profits. It's up to you to pre-screen all time wasters and be able to tell the difference between a good prospect, okay? A good prospect and a suspect. Stay away from the suspects. All this can be done with pre-contract due diligence. It's simple. It's simple, and yet so many people still don't do it. Those investors, the conventional wisdom investors, are still out there. They're taking, so long, sometimes 3, 4, 6, 12 months to even analyze a deal. And you know what? They're spending money when they're doing it. And they're spending time that they can't get back. Here, our system, one page. It's a deal, it's a dud. It's a deal, let's verify the information. In days, we have pre-contract due diligence completed without a penny out of pocket, and we know if that's a deal or not. And we're already putting that thing down on an executive summary to submit to our lender to make sure that the lender wants to fund on it, to give us a commitment letter so we can go back to the seller and negotiate the right terms prior to even putting a contract on the thing. Is that smart? Yeah. That's what separates the pros from the Joes, guys. All right? And if we need to put a contract prior to us taking any time on the deal, we will have a letter of intent. And we will have a relationship in place if we don't have a binding contract to make sure that we're not wasting time. So it all comes down to a case-by-case scenario. If you missed that the first time, don't worry. I'm going to slow down and cover it in detail because that's what I'm here to do. All right?